I think I'll kick off now and get started with the big picture. So we started last Monday talking about US CPI reaching record highs and the possibility of a 75 basis points rate hike from the Fed, which could mean more pain for the equities. And that's exactly what happened this past week. What made it even tougher for equities was that a host of other central banks as well joined the tightening bandwagon. It kind of appeared, they at least appeared more serious about tightening, and the clear outlier still being the BOJ, the Bank of Japan, and we'll get to that later. But what that has really meant now is that we have seen a rising recession fears as well, or at least I should say fears of slowdown in economic momentum. So that's been like a double whammy for equity markets. The S&P ended the week down over 5.5%, Nasdaq down close to 5% as well. And the kind of price action that we've seen last week is actually making history because everything is down and investors are having trouble finding a haven. We've seen losses in treasuries, and some of the commodity sectors have also come under stress. The WTI crude oil was down 9%, industrial metals suffering as well. Even crypto had a bad weekend. Bitcoin fell below 20K for the first time since December 2020, which is a broader sign of stress in the financial markets as liquidity conditions are tightening. That being said, there are still opportunities in bear markets, and that's what we want to help you to find. To begin with, again, let's get into some of the macro details from last week. So as I said, globally, we've seen an uptick in hawkish rhetoric from central banks. The Fed raised rates by 75 basis points. We had a surprise from Swiss National Bank, which announced a 50 basis points rate hike. Just a reminder that Swiss National Bank is actually one of the most dovish central banks as well. So that did come as a big surprise and kind of helped the Swiss franc to be the best performer on the currency board as well last week. We had the Bank of England raising rates by 25 basis points and still highlighting a possibility of a 50 basis points move in August. The 25 basis points rate hikes are no longer the norm, which is a big change from the previous week, and will be important to watch this week as we have several Fed speakers and especially Chairman Powell giving testimony to the Congress this week. Although I think it's hard to kind of see any shift in policy. The more important things to watch out for will be the tug of war between inflation and recession concerns. After we also had a series of weak data from the US last week, and the concern around a technical recession is really building up. So remember that Q1 GDP was already negative, and now the Atlanta Fed's GDP tracker is projecting that economic growth in the second quarter will be 0%. The moment that turns negative, we have 2 quarters of negative growth, and that does mean a technical recession. So for markets, it will be important this week to kind of continue to watch economic data as well as sentiments. There will be some bounces in equities, of course, because recession concerns means markets start to expect a Fed pivot, at least going into next year. So that helps the equities to bounce a little bit. But overall, we are still in a bear market trend with more room to go down. The only outlier, like I mentioned, in major central banks remains the Bank of Japan. It continued with its accommodative policy on Friday. That was after some expectations had started to build for a move, more so because of the rise in global yields, but also the markets have been testing Japan's, in the FX and the bond markets, both have been testing the BOJ's resolve. But Kuroda, the chief of BOJ, hasn't caved in yet. He remains committed to bringing back wage inflation in Japan, which has meant that the yen is still close to 24-year highs. It's around 135.30 this morning, with, of course, more room to go down as the yield differentials continue to weigh on the yen. And the USD is also interesting to watch because it looks like it might top out because of this uptick in global central banks' hawkishness. Even though the Fed will still outdo the others, and any routes in the equity markets would mean that dollar is still the safe haven, but the room for dollar gains is certainly running out. That's it for me.
Hi, morning, everyone. Just to add a little bit on the US, and just mindful that we are now towards the quarter end. And that is actually the pension fund, actually, according to market estimates, there would be about still 44 billion kind of rebalancing they need to do. And also there is also quite a lot of derivative expiring in this week, towards the end of the week. So that's just something in terms of positioning, just to update you. And then it's back to China and Hong Kong. And a picture here is slightly better versus Hong Kong and China continue to outperform the other market. Although Hang Seng was down 3.4% and Hang Seng Tech was down 3.6% last week, and but CSI 300 up 1.7%. But all of them actually is better than S&P. S&P was down 5.8%. And MSCI developed market actually is down 5.7%, and MSCI emerging market down 4.4%. So I think mainly is we have the May activity data, including retail sales and industrial production, fixed asset investment, and so on, and slightly better than expected. And then also we have been seeing some inflow. Northbound is inflows more than around 2.6 billion US dollar equivalent. I think mainly is you must have been focusing on the divergence of policy cycle. I mean, China and anyway it has been easing in monetary policy, fiscal policy, and also relaxing some of measures on properties, and also now there's also better visibility in regulatory fund on the internet and e-platform economy. And the lockdown situation has also improved a bit, and now we have only about 6 cities under kind of a partial and district-based lockdown. But remember, about 1 month ago, back in April, there were actually 44 cities in China were under lockdown. So after the Wali and over the last couple of weeks, and Hang Seng now trading at PE 10 times on 2022 earnings, and CSI 300 trading at 14 times. So that is still undemanding, but it's not dirt cheap, and it's more like a mid-cycle kind of average. And also Hang Seng still, I think for still pricing in the EPS growth is still consensus up 7%, and CSI 300 up 20%. Those are maybe subject to some earning downgrades coming, and actually we've been seeing some earning downgrades already lately. So that is it's just to wrap it up, and Hong Kong and China probably will continue to outperform the US, but on the absolute term, it's difficult. It's really, really difficult to sustain a meaningful uptrend when the rest of the world, the economy was slowing, and also the other market are coming down, and all the major central bank are raising interest rates. So I think that we think that the recovery in the Chinese economy will also be slow and bumpy. So Hong Kong and China basically is still in a bear market, but will tend to outperform the rest of the world in the coming days. This is basically our view. And today, later on, in a few minutes time, we have the 1 year and 5 year long prime rate coming out from China. And also this week, we have the standing committee of the China's National People's Congress. They will convene. They will have a meeting. Probably, I mean, the market will be focusing on only 2 things based from this meeting. One is whether they will add to the quota of the local government bond, special bond issuance, i.e. Give local government more money to spend on infrastructure. And also, they will also look at the amendment draft of the anti-monopoly law. And I think that's all for me. Yeah, Jessica, it's all yours.
Thank you, Redmond. Thank you, Drew. Just a couple of key points from me. So just recapping our big picture. So we think the global economy, without giving too much away, in light of our quarterly outlook coming out, we think the global economy is on a runaway train with growth slowing down. And the biggest consumer of commodities, China, alluding to last week that they're probably not going to come out of lockdown until next year. So this comes at a time when Drew mentioned at the top of our get up today, when the US, the UK, the ECB and Australia are rising rates. So we've seen commodities outperform the market. And if you look at the baskets that we track, which you can see on the Saxo portal under shares. And if you have a look at those, commodities are the best performers, followed by defence, but we see commodities taking a bit of a haircut. Moving along to the indices, the US benchmark, the S&P 500, is in a downtrend. We already know that the market has fallen 23%. That's if you look at the largest S&P 500 stocks. There is room to fall still. The next support, the next technical level that we're looking at is 3,500, which again implies further room to fall. The next question is, when do we think we'll see the bottom? We don't think we have seen the bottom yet, and we probably won't see the bottom yet. The reason for this is we've got Q2 reporting season out in the US. Remember, we get numbers from July onwards. We're really interested to see what companies will be guiding for the year ahead. So we need to see corporate profit growth and companies to upgrade their earnings in order for us to really see optimism. The other thing that we're looking for is for consumer confidence levels to pick up. This is important because the US consumer is the biggest part of the US economy and the Australian economy. But until we see these two areas pick up, we don't think we'll see a bottom. Moving along to the ASX 200, the Aussie share market. So our market is not as down as much as the US. And we spoke about the US being down over 20%. Our market's down 14%. There is still further room to fall. The next key support level for the Aussie share market is 6,000 points. That's a technical level, and we do think that'll probably be tested soon. What to consider? A couple of things. So at Saxo, we've seen a move out of industrial metals, so industrial commodities, I should say. So aluminium, copper, iron ore, zinc, etc. And we've seen an increasing amount of clients move out of those key commodities and into the safe havens. And the reason for this is because we see a real risk of a recession. If we don't see a real recession, as in 2 quarters of negative GDP, which we think are very likely, we'll at least see stagflation. So low growth, high inflation. And we see at Saxo this continuing for 2022. In this environment, this supports gold moving higher. So this is why over the past couple of weeks, we've seen gold orders increase if you have a look at the last couple of months. So that's one thing to also keep in mind. Also, gold futures contracts have also increasingly across Saxo globally have seen increased orders. And we see that clients are increasingly taking a view and opting for safe havens to do well. And again, just reiterating, gold traditionally outperforms in environments like we're heading into. Where do we see gold sitting at the end of the year or at the end of the second half? At Saxo, our house view is that gold will hit a fresh record high for reasons that we've just outlined. The second other thing for you to consider before we let you go is that we are in the middle of an energy crisis that's just gotten worse. So this means that in Australia, for instance, we are seeing households left limiting their power because there's a lack of coal and gas getting to the grid. And also this is limiting profits for gas and coal companies. And this is another reason for perhaps you to consider potentially taking profits in some of those fossil fuel contributors that we've been so bullish on. And just lastly, other potential trading and investing ideas to consider. We are advocating for utmost caution to be exercised, and you also consider buffering in downside protection into your portfolio. That might include gold, that might include some US dollar exposure, and potentially using options if you do hold long-term positions that you don't want to sell. And with that in mind, I encourage you to reach out to your RM or your GST, basically your key points of contact at Saxo. With that in mind, all the points that we've covered today will be reiterated in our Saxo Spotlight, which is our weekly outlook for the key points to watch for the week, and we'll also be putting in the key points in our daily digest each and every day. And stay tuned. We really hope to bring you daily and weekly videos very, very soon. Thank you very much, and please stay safe. From all of us, have a happy and safe week. And we'll see you same time, same place, same bat channel Monday morning.
Happy trading week, guys.
Okay, bye-bye.
Bye.
Bye, everyone.